Credit risk and credit risk management. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses credit risk and credit risk management. In this video, you will understand the meaning of credit risk, characteristics of credit risk, forms of credit risk, components of credit risk, factors influencing a firm's credit risk, principles of credit risk management, the framework for a sound credit risk management, credit risk rating framework, categorization of individual loans, functions of a credit risk rating system, expectations of credit risk rating systems, credit events, factors militating against credit risk management, best practices in credit risk management, assessment of credit risk and factors impacting credit risk assessment. Now, let us start. What is credit risk? Credit risk is the possibility that a contractual party will fail to meet its obligations under the agreed terms. Credit risk refers to the probability of loss due to a borrower's failure to make payments on any type of debt. Credit risk is the primary financial risk in the banking system and exists in virtually all income-producing activities. Identifying and rating credit risk is the essential first step in managing credit risk effectively. Credit risk is also variously referred to as default risk, performance risk and counterparty risk. All these terms fundamentally refer to the same thing. For banks and finance firms, credit risk constitutes the possibility of losses associated with a decline in the credit quality of borrowers or counterparties. Default due to inability or unwillingness of a customer or counterparty to meet commitments to lending, trading, settlement, and other financial transactions. Loss from a reduction in portfolio value, actual or perceived. How a bank selects and manages its credit risk is critically important to its performance over time. Indeed, capital depletion through loan losses has been the proximate cause of most institution failures. Characteristics of credit risk. 3 characteristics define credit risk. 1. Exposure, to a party that may default or suffer an adverse change in its ability to perform. 2. The likelihood that this party will default on its obligations, the default probability. 3. The recovery rate, that is, how much can be retrieved if a default takes place. The more significant the first 2 elements, that is, credit risk exposure and the likelihood, the greater the exposure. On the other hand, the higher the amount that can be recovered, the lower the risk. Credit risk can be expressed as, credit risk equals exposure multiplied by, probability of default multiplied by, 1, recovery rate. Forms of credit risk. Credit risk may be in various forms, including 1, non-repayment of the interest on loan or loan principal. 2, inability to meet contingent liabilities such as letters of credit guarantees issued by the bank on behalf of the client. 3, default by the counterparties in meeting the obligations in terms of treasury operations. 4, not meeting settlement in terms of security trading when it is due. 5, default from the flow of foreign exchange in terms of cross-border obligations. And 6, default due to restrictions imposed on remittances out of the country. Credit risk management. Credit risk management is the practice of mitigating losses by understanding the adequacy of a bank's capital and loan loss reserves at any given time. Credit risk management is the process of controlling the potential consequences of credit risk. The process follows a standard risk management framework, namely, identification, evaluation, and management. This process will help a business identify the cause of risk, and the extent of the risk must be evaluated, and decisions should be made on how to manage the risk best. Components of credit risk. There are 2 significant components of credit risk, default and portfolio risks. Default risk is a risk that a borrower or counterparty is unable to meet its commitment. Portfolio risk arises from the composition and concentration of a firm's, for example, a bank, exposure based on its operations. Internal and external factors, for example, state of the economy, fiscal deficit size, and national financial inclusion, can influence a firm's credit risk exposure. Internal factors influencing a firm's credit risk exposure. A business credit risk exposure can be influenced by internal factors, that is, a firm's specific features. For example, a bank can manage its internal factors through adopting a proactive loan policy, good quality credit analysis, loan monitoring, and sound credit culture. External factors influencing a firm's credit risk exposure. A firm's credit risk exposure can be influenced by external factors, including the state of the economy, size of fiscal deficit, and the level of national financial inclusion. Businesses can manage external factors through 1. Diversification of loan portfolio. 2. Scientific credit appraisal for assessing the financial and commercial viability of loan proposals. 3. Setting standards and requirements for single and group borrowers. 4. Established a standard for sectoral deployment of funds. 5. Strong monitoring and internal control systems. And 6. Delegation of duty and effective accountability. Principles of credit risk management. The principles of credit risk management for banks and hire purchase firms is similar. Essentially, the principles of credit risk adopted by each business should be sound and well integrated in the structure and operation of the firm. Here are good principles for credit risk management. 1. A bank's board of directors must take responsibility for approving and periodically reviewing the credit risk strategy. 2. Senior management must take the responsibility to implement the credit risk strategy. And 3. Bank must identify and manage the credit risk of all banking products and activities. Credit risk management framework. Regardless of the credit risk management framework adopted by a firm, a sound credit risk management framework should include the following 8 components: 1. Policy framework. 2. Credit risk rating framework. 3. Credit risk limits. 4. Credit risk modeling. 5. Credit risk pricing. 6. Risk mitigation. 7. Loan review mechanism. And 8. Credit audit. Now, let us examine the 8 components of sound credit risk management. Policy framework. The credit risk policy framework should clearly articulate the firm's credit risk strategy and policy, operations and systems support, and organization structure. For clarity, it is good to consider key aspects of the policy framework of credit risk management. Strategy and policy. A sound credit risk management strategy and policy should address the following areas. 1. Documented policy specifying target markets. 2. Statement of risk acceptance criteria. 3. Credit approval authority. 4. Credit follow-up procedures. 5. Guidelines for portfolio management. 6. Systems of loan restructuring to manage problem loans. 7. Follow-up procedures and provisioning of non-performing loans and advances. 8. A consistent approach to early problem recognition. 9. Classification of exposures in problem loans. 10. Maintain a diversified portfolio of loans in line with the desired capital. 11. Procedures and systems for monitoring the financial performance of customers. And 12. Controlling outstanding loan performance so that the non-performance is within limits. Organizational structure. A sound credit risk management should be well situated with a firm's organizational structure. For example, bank credit risk management should provide for 1. Independent group responsible for credit risk management. 2. Formulation of credit policies. 3. Procedures and controls of all credit risk functions. And 4. Credit management team responsible for overall credit risk. Board of Directors. The Board of Directors should oversee its overall credit risk management policy based on its credit risks exposures, including credit, liquidity, interest rate, foreign exchange, and price risk. To ensure a sound and effective credit risk management system, necessary committees should be set up and well integrated for the overall success of the company's credit risk management policy and framework. The company should set up the following committees: Credit Risk Management Committee, Market Risk Management Committee, Operations Risk Management Committee and Asset Liability Management Committee. Credit Risk Management Committee. The company's Credit Risk Management Committee should be properly integrated with the company's Market Risk Management Committee, Operations Risk Management Committee and Asset Liability Management Committee. Business Operations and Systems Support. Credit risk management should articulate phases of credit processing. Generally, credits processing consists of 3 phases: relationship management, transaction management, and portfolio management. 1. Credit risk relationship management phase. The relationship management phase is the first phase of credit processing. This is the phase where the bank interacts with customers by introducing the company's type and nature of credit facilities. The activity involved in this phase include business development, product development and system development. 2. Credit risk transaction management phase. This is the second phase of credit processing. The customer would be required to complete appropriate credit application forms, and the application should be processed. The customer's creditworthiness and background credit check should be undertaken to reduce the risk of repayment default. A thorough credit risk assessment of the customer should be undertaken. The credit risk assessment should cover the area of pricing, structuring of the credit operations, internal approvals, documentation, loan administration and credit monitoring and measurement. 3. Credit risk portfolio management phase. The portfolio management phase is the final stage of credit processing. The essence of this phase is to monitor the repayment of the credit facility and minimize the risk of repayment default. Essentially, a sound portfolio management phase should include good credit risk portfolio monitoring and management of problem loans. Credit risk rating framework. A major technique for measurement and monitoring credit risk for loans other than personal and mortgage loans are the technique of credit risk ratings. Risk ratings are most applied to all loans, other than private and residential mortgage and bridge loans. A credit risk rating system is a formal process that credit facility providers, for example banks and finance companies, use to identify and assign a credit risk rating to credit and loan facilities. It will enable the management to assess credit quality, identify problem loans, monitor risk performance, and manage risk levels. Credit risk rating should be used for loan pricing to ensure loans are appropriately priced for the risks. A well-managed risk rating system also gives the board of directors, auditors, and regulators information they can use to assess the overall health of the business portfolio. A credit risk rating system involves categorizing risk associated with an individual loan using a thorough credit analysis that considers market conditions, industry data, and other factors necessary to assess a borrower's credit quality. Loans are rated using a series of graduated ratings that represent an increased risk. Risk ratings should be applied to all commercial loans. When should credit rating be conducted? Risk ratings should be conducted in the following 3 circumstances: 1. At the time of application for all new or increased loan facilities. 2. As part of the annual review process. And 3. In situations where new information is considered that may materially affect the credit risk of the loan. Categorization of loans. Risk rating involves categorizing individual loans, based on credit analysis and local market conditions, into a series of graduated categories of increasing risk. No single credit risk rating system is best for all credit provided. The scope and scale of a credit risk rating system will depend on various factors, including types of credit product or facility, repayment duration, and the loan portfolio's complexity. In many situations, a system comprised of 6 risk levels of increasing credit risk is appropriate. Under this system, the lowest risk rating, 1, is assigned to undoubted borrowers with virtually no risk. The highest risk rating, 6, is assigned to borrowers with little or no repayment likelihood. Loans should only be granted for risk ratings of 1, 2, low risk, or 3, normal risk. Ratings of 4, 5 and 6 are reserved for existing loans where the risk rating has deteriorated since the original approval. Risk rating 4 is a cautionary rating assigned to higher risk loans. Loans in this category should be placed on a watch list for increased monitoring. Risk rating 5 is for unsatisfactory loans that are impaired. Functions of a credit risk rating system. A sound credit risk rating system should promote a firm's, for example, a bank or finance company, safety and soundness by ensuring well-informed decision-making. Rating systems measure credit risk and differentiate individual credits and groups of credits by the risk they pose. For instance, a sound rating system will enable a bank and examiners to monitor changes and trends in risk levels. The process also allows the bank management to manage risk to optimize returns. Credit risk ratings are also essential to other vital functions, such as 1. Credit approval and underwriting. Credit risk ratings should be used to determine or influence who is authorized to approve a credit, how much credit will be extended or held, and the structure of the credit facility, including collateral, repayment terms and guarantor. 2. Loan pricing. Credit risk ratings should guide in price setting. The price for taking credit risk must be sufficient to compensate for the risk to earnings and capital. Incorrect pricing can lead to trouble and return imbalances, revenue reduction, and adverse selection. 3. Relationship management and credit administration. Credit risk rating should determine how the relationship is administered. High-risk credits should be reviewed and analyzed more frequently, and high-risk borrowers typically should be contacted more frequently. Problem and marginal relationships generally require intensive supervision by management and problem loan/workout specialists. 4. Allowance for loan, lease losses and capital adequacy. Credit ratings of individual credits underpin the allowance for loan and lease losses. Every credit's inherent loss should be factored into its assigned risk rating with a budget provided individually or on a pooled basis. The allowance for loan and lease losses must be directly correlated with the level of risk indicated by risk ratings. Ratings are also helpful in determining the appropriate amount of capital to absorb extraordinary, unexpected credit losses. 5. Portfolio management information systems and board reporting. Risk rating reports that aggregate and stratify risk and describe risk trends within the portfolio are critical to credit risk management and strategic decision-making. 6. Traditional and advanced portfolio management. Credit risk ratings significantly influence banks' buying, selling, holding, and hedge credit facilities. Expectations of credit risk rating systems. No single credit risk rating system is ideal for every bank. Specific attributes should be present in all scenarios, but how banks combine those attributes to form a process will vary. Credit risk rating systems should possess the following attributes. 1. The system should be integrated into the bank's overall portfolio risk management. 2. The board of directors should approve the credit risk rating system. 3. All credit exposures should be rated. 4. The risk rating system should assign an adequate number of ratings. 5. Risk ratings must be accurate and timely. 6. The criteria for assigning each rating should be clear and precisely defined using objective and subjective factors. 7. Ratings should reflect the risks posed by both the borrower's expected performance and the transaction's structure. 8. The risk rating system should be dynamic. 9. The risk rating should be independently validated. 10. Banks should determine through backtesting whether the assumptions are valid. And 11. The rating assigned to credit should be well supported and documented in the credit file. Credit events. Credit risk may take the form of credit events. There are several types of credit events. Credit risk can be insured and transferred to another party. The market that has developed in credit risk transfer is known as credit derivatives. Events undertook within a credit derivatives market constitutes credit events. Examples of credit events include 1. Bankruptcy or insolvency under corporate law. A firm will be dissolved if it is declared bankrupt or insolvent by a court of competent jurisdiction. 2. Credit after a merger. Assets are transferred, with a negative impact on the ability to pay, or the legal entity is consolidated into another company. 3. Cross-acceleration. Other obligations of the legal entity become due before maturity owing to a breach of contract. A debt contract is a legally binding agreement requiring the borrower to pay the debt owed appropriately within the stipulated period. 4. Cross-default. Obligations of the legal entity have been declared in default. Under debt contracts, failure to perform one set of commitments leads to the automatic declaration of other commitments to be in default, even if these obligations have not experienced any breach of contract, covenant. 5. Currency convertibility. Foreign exchange controls in a particular country or countries prevent repayments in the affected currency or currencies. Currency convertibility is often linked with currency risk. Country risk is associated with lending to a particular country, whereas default risk is usually company-specific. 6. Downgrade. This is a situation where an obligor has a downward. This will result in an adverse change in the credit rating of the obligor. This may include the cancellation of the available rating. A downgrade might make the holder sell the obligor's debt securities. 7. Restructuring. Restructuring means deferment or rescheduling payment of outstanding debt. A legal entity, for example, a firm, an organization or a country, can defer or reschedule outstanding debts. Generally, debt restructuring might reduce the interest payable, postpone payments, change the obligation's seniority or extend its maturity. 8. Failure to pay. The legal entity is not able to or does not make the contractual payment. 9. Government action. Any actions by a government or an agency of government that results in outstanding claims becoming unenforceable against the legal entity. 10. Market disruption. This is a situation where the tradable securities of the obligor cease trading. 11. Moratorium on debts. This refers to the ability of a legal entity to declare a standstill on its existing debts and interest payments. 12. Obligation acceleration. A contractual obligation becomes payable before its due maturity owing to default by the legal entity. This is similar to, but not identical to, cross-default. Obligation acceleration refers to a direct obligation with an affected party, whereas cross-default refers to a third party. 13. Obligation default. This means that an event of default has occurred in the legal entity's obligations. 14. Repudiation. This means that a legal entity disaffirms or disclaims its debts. Factors militating against credit risk management. Amongst others, here are 5 factors militating against firms, for example, banks and finance companies, credit risk management system. 1. Inefficient data management. The business's inability to access the right data when needed will cause problematic delays in a credit risk management system. 2. No group-wide risk modeling framework. Without a group-wide risk modeling framework, banks cannot generate complex, meaningful risk measures and get a big picture of group-wide risk. 3. Constant rework. Analysts cannot change model parameters easily, which results in too much duplication of effort and negatively affects a bank's efficiency ratio. 4. Insufficient risk tools. Banks cannot identify portfolio concentrations or regrade portfolios often enough to effectively manage risk without a robust risk solution. 5. Cumbersome reporting. Manual, spreadsheet-based reporting processes overburden analysts and information technology. Best practices in credit risk management. Credit risks management activities may vary from a firm to another, but it is paramount for a business to adopt sound credit risk management practices. Here are some best practices in credit risk management, using banks as the basis. 1. The first step in effective credit risk management is to gain a complete understanding of a bank's overall credit risk by viewing risk at the individual, customer, and portfolio levels. Vulnerable banks are targets for scrutiny by regulators and investors, as well as debilitating losses. 2. While banks strive for an integrated understanding of their risk profiles, much information is often scattered among business units. Without a thorough risk assessment, banks have no way of knowing if capital reserves accurately reflect risks or if loan loss reserves adequately cover potential short-term credit losses. 3. The key to reducing loan losses and ensuring that capital reserves appropriately reflect the risk profile is implementing an integrated quantitative credit risk solution. A well-integrated credit risk solution should get banks up and running quickly with simple portfolio measures. It should also accommodate a path to more sophisticated credit risk management measures as needs evolve. An integrated credit risk solution should include 1. Better model management that spans the entire modeling life cycle. 2. Real-time scoring and limits monitoring. 3. Robust stress testing capabilities. And 4. Data visualization capabilities and business intelligence tools that get important information into the hands of those who need it when they need it. Assessment of credit risk. Assessment of credit risk requires modeling the probability of a counterparty defaulting obligation wholly or in part. We can picture the credit decision in terms of the primary risk management model. The credit decision may be either granting of credit or refusal of credit. For a business, the essence of credit risk management is to balance the gain from the credit risk by extending a credit against the potential loss. The credit risk decision facing a firm relates to the gain, if there is no default, the potential loss from extending credit based on the likelihood that default takes place, and the amount lost if a default occurs. The two possible outcomes of credit risk are that the credit performs based on the expectation or the credit defaults. If the credit defaults, the cost to the credit manager will be the cost or the replacement value for what has not been provided. Determinants of credit risk assessment. As mentioned earlier, individual credit risk should be assessed. Here are 4 key factors influencing a credit risk assessment. 1. Concentration risk arises when there are many exposures to parties that share similar characteristics. 2. Settlement risk arises when a clearing agent or third party processes transactions for other parties. 3. Industry risk applies mainly when the domestic or international economy is in recession, and the poor economic conditions affect specific industries. And 4. Country risk arises from exposure to individuals and institutions in countries with legal systems, business codes, and standards that differ from those of the lender. The following 4 core country risk factors can impact a credit risk assessment: political risk, economic risk, currency risk, and enforcement risk. Political risk arises when a country's government is challenged externally or from within national borders. Political risk is more problematic in long-term lending agreements than in short-term transactions. Economic risk relates to depressed or declining financial stability in a country. Currency risk arises with cross-border lending, exchange rate fluctuation. Enforcement risk emanates from the legal system in the debtor country because a creditor must go through a foreign legal system. Moreover, debtors are expected to use their domestic legal process to avoid paying, claiming that rules from their home country apply. Conclusion. Credit risk and credit risk management have been discussed in this video. Credit risk is the possibility that a contractual party will fail to meet its obligations based on the agreed terms. Credit risk refers to the probability of loss due to a borrower's failure to pay any debt. Credit risk is also known as default risk, performance risk and counterparty risk. Credit risk is the primary financial risk in the banking system and exists in virtually all income-producing activities. Identifying and rating credit risk is the essential first step in managing credit risk effectively. A business should manage its credit risk exposure effectively. Credit risk management is the process of controlling the potential consequences of credit risk. I hope the video is educative and beneficial to you. Which aspect of credit risk and credit risk management discussed in this video do you consider to be most important? Please post your response below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.